How's it going today, guys? I hope you're having a fantastic day. I do have a couple of quick updates for you guys, but if you want to just skip right ahead to the video, I'm going to include a timestamp down in the comment section below, so you can go ahead and just click on that and skip ahead if you're just wanting to get right ahead to the video. But a couple of updates for you guys. First of all, as I'm sure you guys noticed, I took a quick break from uploading on YouTube. I took a trip to Washington, D.C. first of all. And while I was away, I was kind of thinking about what I wanted to do with the channel. And the one thing I really stressed above all was that I wanted to be more organized and maybe structured with the content I'm putting out there. And so I actually put a vote out there to my community there on that video. And the vote was only up for about 24 hours. But basically, I asked people what they were looking to see from my channel. And the top three things were, number one was passive income. Most people want passive income related videos. Number two was stock market analysis of individual stocks. And number three was stock market strategy. So that's exactly what you're going to be getting from this channel now. Earlier on in the week, I'm going to be doing a video that's either on analysis of a particular stock, or it's going to be a stock market strategy type video. And then later on in the week, it's going to be a passive income style video. And then anything else that I want to do that might not fit that, I'll end up uploading on the weekends. So going forward now, expect about 2 to 3 videos a week from my channel. Earlier in the week being the stock market stuff, later on in the week being the passive income related videos. Now that being said, I'm also going to continue my giveaway of my Stock Radar membership every single week. That's my weekly stock analysis membership site, and it is closed up until August 1st or a little bit thereafter. I'm not sure what date I'm going to open it. So the only way you can get in right now is by entering that giveaway. And so I'm going to do the giveaway next week to start that up again. And then every single week I'm going to be announcing a winner for that. And all of those details for how to enter are down in the description below. But anyways, let's go ahead and get into the video here and talk about a stock that a lot of people have been messaging me about. I've been seeing it mentioned in the comments of different videos, and that is a stock called CenturyLink. It's a company that I honestly had not heard of before until I had so many people contacting me about it. I said, all right, I better look into it. So CenturyLink trades on the New York Stock Exchange under the symbol CTL. And take a wild guess why people are interested in this stock. It's because of the fact that they have an 11.5% dividend yield. This stock is currently paying out a massive dividend. It is one of the highest yielding dividend stocks out there right now. And so a lot of people are looking at that and saying, boy, would I love to have a 12% dividend. But in this video, what I plan to do is talk about whether or not this is a dividend you can rely on and whether or not you should be buying CenturyLink stock for that 12% dividend. Now, a little bit more on this stock here. They have a price to earnings ratio of 10.5 according to Yahoo Finance and a forward PE of 17.8. And so that alone indicates to me that earnings are expected to decline in the future when you're seeing a forward PE ratio higher than the current price to earnings ratio. So earnings are expected to decline for this company based on future estimates. A little more background on this company. This is the third largest United States telecom company. They offer communication services to residential, business, and government customers, and 75% of their revenue comes from business customers. So most of the customers they are serving are business-related customers. So first of all, I want to talk about the telecommunications services sector as a whole because it's been doing terrible over the last year here. So on the bottom right there, this is from the Fidelity Sectors and Industries tool. It's a tool that I like to use when I'm looking at the different sectors and industries and comparing them to the overall market. And as we can see here, over the last year, the S&P 500 has returned about 13.04%, and the diversified telecommunications services sector has returned a negative 7.4%. So it has underperformed the market and it has declined in the last year. So let's go ahead and look on the left there. Those are some of the competitors of CenturyLink. Now, like we said, CenturyLink mostly works with business customers, so these aren't going to be direct competitors, but all of these companies are in that diversified telecommunications services sector. And I just kind of ranked them from the top to bottom as far as where they're falling, just to give you an idea of what these stocks are doing and how they're performing. So Verizon, despite the fact that the sector is down as a whole, they're actually up 7.8% over the last year. T-Mobile is down 4.5%, Comcast down 14.8%, AT&T, the behemoth, down 17%, and they actually fell quite a bit after it was announced that the deal with Time Warner went through, largely because I think shareholders of AT&T are concerned about the debt that AT&T is taking on. CenturyLink down 24.2% over the last year, and then Sprint is down 32.3%. Sprint is a little bit over $5 a share now, so they're almost considered a penny stock at this point in time, trading at a share price of under $5 a share, which is unbelievable. But that's what's going on within diversified telecommunication services, and that gives you an idea of where CenturyLink is falling. They are one of the worst performers here of these large telecom companies. And again, the reason why people are interested in this stock is because the average dividend of a stock on the S&P 500 is around 2%. The average dividend in the telecommunication services is 5.7%, and this dividend is almost a little bit more than double the average dividend in telecom services. So that right there is why people are interested in this stock. But one of the things I always stress on this channel is that you should not solely invest in the stock because of the dividend. In fact, the dividend should kind of be the afterthought. The number one thing you want to be looking for is asset appreciation, to make sure the actual share price is going to appreciate, and then if you get a dividend as well, that's kind of the gravy. But a lot of people solely look for high dividends, and this might be a trap here. So let's go ahead and talk about why this dividend might be cut in the future. So first of all, let's go ahead and determine whether or not CenturyLink can even afford to pay this dividend. Now, there's a couple of different ways you can do this. I always rely on the dividend coverage ratio, and that you calculate by taking the earnings per share, and you can do this quarterly or annually, divided by the dividends per share. And if that number is below 1, that means that they are paying more in dividends than they are earning per share, meaning they can't afford that dividend. So starting back there, let's look at 2014. They had earnings per share of $1.36 and a dividend per share of $2.16, giving them a coverage ratio of 0.63, meaning they could not afford the dividend in 2014. They couldn't afford it in 2015 either. They could not afford it in 2016. However, in 2017, they earned $2.21 per share, and they paid $2.16 in dividends, so they had a coverage ratio of 1.02, meaning they barely could afford that dividend. When I'm investing in a stock, I want to see a coverage ratio of above 1.5. That's usually a good amount of wiggle room for the company to be making a good profit themselves and retaining earnings, and also being generous with the shareholders. And so a 1.02 is not a dividend you can rely on, especially given the last 3 years there of not being able to afford that dividend and having to go into debt paying out that dividend. And so that right there is an indicator that this company cannot afford to continue to pay this dividend based on where their earnings are at now. Now, if their earnings improve down the road and they're making more money, then yes, they could be able to afford that dividend. But when you're looking at an industry or sector that's suffering overall and having a hard time growing, that is when you have the question of, will this company be able to, improve their earnings and make more money and improve their earnings per share? So one of the things you're going to hear a lot about with CenturyLink is their acquisition of Level 3 Communications. CenturyLink acquired Level 3 Communications in 2017, and this expanded their Fios network and high-speed data for business customers, which is a key growth area for telecom right now. And so basically what is happening right now is that old communication is dying. Landline phones are dying. People are not, having landline phones. I certainly don't have one. And pretty much everybody I know has cut the landline telephone service to their home. And so because that legacy part of their business is declining, they're responding by buying new communication assets. And Level 3 Communications was a new communication asset company, primarily with this Fios and high-speed data for business. So the overall problem that CenturyLink is having is indicated on the bottom left there. It's a problem of revenue stability. So there's a decline in the revenue from the old communication assets because people are cutting the cord and getting rid of their landline telephone services. But the new communication revenue is not increasing fast enough to offset those losses. And so they haven't quite reached stability, where hopefully they would reach a point where their new communication investments would begin to grow revenue and they would see revenue growth going forward. So they're still in stages of seeing declining revenue due to the dying off of that legacy portion of their business. Now, the other problem we have to talk about here is the fact that the Level 3 Communications CEO is going to take over as CEO of CenturyLink in January of 2019. And oftentimes when you see a new CEO taking control, one of the first things they're going to do is cut that dividend. We saw that same thing take place with General Electric when the new CEO took over. John Flannery, one of the first things he did was cut that dividend because it didn't make financial sense for that company to pay one. And so we could easily see this happen with CenturyLink, where one of the first orders of business here is to cut that dividend because they can't afford to pay it. So that right there, I think, is one of the biggest threats to that dividend, is the fact that there's going to be a new CEO taking over in January of 2019. Moving on, we now look at one of the other big problems for CenturyLink, and that is the fact that they are going into a lot of debt. So what they're doing is they're acquiring these other newer communication companies like Level 3, but as a result, they're burdening themselves with a lot of debt. And this is kind of what a lot of these telecom companies are doing. We also saw this happening with AT&T buying the Time Warner assets and trying to diversify, but in the process, they are building up their debt and taking on massive amounts of debt. So on the bottom there, we have the liabilities for CenturyLink from 2014 to 2017, and as you can see, they really began to grow from 2016 to 2017. That was when they acquired Level 3 Communications, and their long-term debt more than doubled in that period of time, from 18.1 billion to 37.2 billion. And so total liabilities went through the roof. And as a result of their increase in debt, their credit rating was downgraded to junk quality by S&P, Standard & Poor's, and I believe all of the major rating agencies have them rated as junk as far as their borrowing goes. And so these agencies don't have strong confidence in CenturyLink's ability to pay back that debt. So the overall problem was the cord cutting trend happening and the decline of the old communication assets and landline communications. So their solution was to buy new communication assets. That led to another problem of being burdened with debt, and the debt load, particularly the long-term debt, ballooned out of control, and then the rating agencies downgraded their debt to junk rating. However, the one thing we do have to say here is that the telecom sector is known for being a cash flow machine because it is a subscription type business where you know exactly what you're going to be paying for your landline telephone or for your data or for your wireless plan every single month. And because it's a recurring revenue business, they are a cash flow machine. So that does give them a good ability to pay back that debt because they have a good recurring revenue model. But they still have a sizable debt load, and the major agencies there are not confident about their ability to pay back that debt. So overall, that is what is going on with CenturyLink. That is why we have seen that stock fall about 25% in the last year, and you cannot count on this dividend. There's nothing saying that this dividend is safe or that it's not going to be cut. Now, if it is cut, the one thing you have to remember is that right now they're paying about a double yield compared to what most of these telecom companies are paying out. And even if it was cut 50%, that would still be a sizable dividend, and it might be an interesting investment. But I just don't really have confidence in the telecom industry overall, just for these main reasons here. First of all, we know old communication is in decline. Second of all, the value wireless options are improving, and that's more towards, the industry overall. So that was one of the problems I have with AT&T, is that the value options like Straight Talk are really improving their service and reliability, and more people are moving away from these large carriers and going for these value options. Number 3, high-speed data and new communications is the growth opportunity for these telecom companies, but number 5 is going to be the counter to that, because network upgrades are very capital intensive, and that again is just going to contribute to the debt problem these companies have. They're either going to be laying out massive amounts of cash to upgrade their networks, or they're going to be acquiring smaller companies and again taking on more debt. And overall, the cord cutting is on the rise, and these are the major threats to that industry. So would I be running out to buy CenturyLink stock? I would not. I would at least wait until the new CEO takes over and take a look and see what his plans are. But do keep in mind that one of the first things that usually happens when a new CEO takes over is that they look at the company and they say, okay, is this making financial sense? And if it isn't, they're not afraid to make some drastic changes. And so I do think that there is a threat there with that dividend. But even if it is cut, they might still pay a sizable dividend compared to their peers. So if CenturyLink can achieve revenue stability, maybe they'll be able to keep this dividend where it is. I certainly don't have much confidence in that dividend, but I just wanted to share my thoughts with you guys on this stock. But anyways, guys, I hope you enjoyed this video. Let me know what you think down in the comments section below. And if you guys have any ideas as far as videos you'd like to see here or a stock to analyze, make sure you let me know down below as well. The giveaway for Stock Radar is going to start again next week, so make sure you guys enter that if you're interested, and I will see you in the next video. If you are interested in learning more about investing in the stock market, I've created a free course just for you. The link is in the description below. Here are a few other videos you might enjoy as well.